We'll call this hearing to order, and good afternoon and welcome to today's hearing on breaking through the regulatory barrier, what red tape means for the innovation economy. Bloomberg recently reported that the U.S. dropped out of the top 10 in the 2018 Bloomberg Innovation Index for the first time in 6 years. We were at 9, and now we are at number 11. Such news is a call to action. America's tradition of invention has been at the heart of our economic strength. As lawmakers, we must recognize that the only way forward is to place our trust in the American people and to get out of the way. The private sector knows all too well how needless red tape imposes costs on businesses, increases prices for consumers, and reduces consumer choice. For innovation, however, the impact can be worse. In Washington, regulators can put an idea to death before it is ever even tried, foreclosing a future of opportunity and progress. We should know better. Americans enjoy a better quality of life today than decades ago, thanks to technological innovation. U.S. leadership in the world has been based largely on technological prowess, and for it to continue, our regulations must foster innovation rather than inhibit it. We will hear examples from our witnesses today of regulation hindering advances and, perhaps worse, even driving it away to other countries. And not all regulation is bad. After all, some is important for giving job creators necessary guidance and stability in their work. And when done well, sound regulation can make up for where markets fail to appreciate important public benefits or costs. And that's why we're holding this hearing. How should we approach regulation so that it's as dynamic as America's tinkerers and inventors? In other words, how can we stop hurting and start helping more? Our regulations should always serve the public interest with minimum collateral damage to the economy. Where innovations are concerned, regulators shouldn't slam the door in the face of new ideas. Our economy in particular, the American people themselves, should be given the opportunity to integrate these innovations in their lives. An advance that can improve lives and raise productivity generally leads to higher wages, and many Americans are in dire need of that kind of prosperity. After all, technological progress is what ultimately brings us better living standards. And it makes little sense to thwart promising innovations that can make our lives easier, improve our health, provide new products and services, and then help the United States firms compete internationally. Consider that the majority of startup firms are in the tech sector. We should encourage the dynamism they contribute to the economy. If we fail to make improvements, fast-moving technology will be moving offshore even faster. And as we will hear today, sound regulation is aware of and anticipates technological change. I like the concept of permissionless innovation. Our inventors and entrepreneurs should not have to ask for permission to make things better. The U.S. technological edge and competitive advantage in a variety of sectors is narrowing, and to some extent through unforced, self-inflicted regulatory wounds. I'm keenly interested to hear what our expert witnesses have to say today, especially how we might improve our regulatory regime. Before I introduce the witnesses, though, I'd now like to recognize Ranking Member Senator Heinrich for his opening statement.
Thank you, Mr. Chairman. I'm pleased that we are again looking at the question of how to accelerate the pace of innovation. We come at this issue from different perspectives. My Republican colleagues seem to believe that only regulations are holding back innovation. Yet dialing back the clock on rules designed to protect consumers doesn't help small businesses innovate and grow. Small firms, like small cities and towns, need fair rules of play. They need rules that give consumers and entrepreneurs a fair shake, and rules that help improve access to capital. When I talk with small businesses across New Mexico, the thing they are most concerned about is limited access to capital. That's why I asked Ms. Milano to testify today about the difficulties that small firms encounter gaining access to capital to launch and to grow their businesses. I believe her testimony will shed additional light on this important issue. What's slowing innovation are barriers to capital and misguided tax policies. Let's start with taxes. Republicans just passed a tax law that lavishes huge tax benefits on large corporations. At the same time, the new law makes the tax code more complex for small firms. Corporations are using their tax savings to buy back their stock, not to invest in plants or workers. So far, companies have announced more than $400 billion in share buybacks, including $100 billion from one company alone. Those buybacks will do little to boost worker wages or to spur innovation. Instead, we should be focused on supporting the next generation of companies, ensuring that those who want to start or expand a business have the tools and the access to capital that they need. New businesses are the lifeblood of the economy. They drive innovation, they drive productivity, and they drive jobs. Yet new business formation has been declining for decades. And the startups we do see are increasingly concentrated geographically. Half of the increase in business establishments between 2010 and 2014 was in 20 counties. Fully 60% of counties saw a net decline in establishments during this period. Increasingly, banks are unwilling to take the risk on small loans that have high fixed costs and lower profit margins. More than half of small businesses seek loans of less than $100,000. Yet those loans have fallen from 33% of bank lending in 2008 to 22% in 2016. While it's hard for many small firms to access the funds that they need to start or grow their businesses, it's especially challenging for women-owned and minority-owned firms. These firms have less wealth to draw from to launch their businesses and also face higher borrowing costs. Community Development Financial Institutions, or CDFIs, help to fill the void, often making loans to those who can't get them from commercial banks. Yet the Trump administration has proposed effectively eliminating the Treasury Department's CDFI fund. We've got to tackle the access to capital challenge from all sides. And it starts with encouraging venture funds to identify and support promising startups beyond the urban hub on the coasts. SBA's Small Business Investment Company Early Stage Initiative helps to broaden the base of venture funding nationally. We need to support small business lending through SBA's capital programs, the CDFI fund, and other channels. And we need to work toward greater lending transparency in the private sector. A growing number of online lenders are using technology and access to data to attempt to fill gaps in small business lending. But we need to ensure that these loans are safe. We should look at the financial protections we extend to consumers as a blueprint for how we can and should protect small business borrowers using these new financial products. While access to capital is critical, there are other factors that are important to enabling innovation. These include federally funded research and development and access to quality K-12 education and affordable post-secondary options. Investing in human capital while promoting greater access to financial capital will enable the United States to continue to lead in the 21st century economy. And I'm very much looking forward to the testimony from all of today's witnesses. Thank you, Mr. Chairman.
Thank you, Senator Heinrich. And before we introduce the witnesses, let me just welcome a lot of students who are here today from the Close-Up program. Thanks for joining us here and watching our hearing. We'll start with Mr. Brinkman, who is the Secretary of the Executive Cabinet in Kentucky Governor Bevin's administration. In this capacity, he oversees the various cabinets and is responsible for implementing the governor's policies and programs. He is also currently serving as acting secretary for the Cabinet of Health and Family Services. Previously, Brinkman represented the 32nd Legislative District in eastern Jefferson County in the Kentucky House of Representatives from 2001 to 2010. Brinkman practiced law in Louisville for 35 years, specializing in corporate, real estate, and public finance law. He is a member of the Health and Welfare Committee during his entire tenure in the House of Representatives, as well as a member of the Appropriations and Revenue Committee during his last 8 years as a state representative. Dr. Kennedy is a senior fellow at the Information Technology and Innovation Foundation. For almost 3 decades, he has provided legal and economic advice to senior officials in the public and private sector on public policies involving technology, competitiveness, and the social contract. Dr. Kennedy previously served as the chief economist for the U.S. Department of Commerce. He has held numerous other positions in government, serving on committees in both houses of Congress and in the executive branch. He also was a senior economist on the Joint Economic Committee. So welcome back, Dr. Kennedy. Dr. Kennedy has a law degree and a master's degree in agriculture and applied economics from the University of Minnesota and a PhD in economics from George Washington University. Mr. Koopman is a Senior Director of Strategy and Research at the Center for Growth and Opportunity at Utah State University. He is also a senior affiliated scholar at the Mercatus Center at George Mason University, where he has also taught in both the economics department and at the George Mason University School of Law. His research specializes in regulation, competition, and innovation, with a particular focus on public choice and the economics of government favoritism. Mr. Koopman earned his JD from Ave Maria University and his LLM in law and economics at George Mason University. And Ms. Milano, who is with us today, is a VP and Director of ESG Investment Research at Calvert Research and Management. Before joining Calvert, she served as the Deputy Assistant Secretary for Small Business, Community Development, and Housing Policy at the U.S. Department of the Treasury. And prior to joining the Department of the Treasury, Jessica served as Senior Advisor to the Administrator at the U.S. Small Business Administration. Ms. Milano also holds an MA in Applied Economics from Johns Hopkins University and received her BS in Government from the London School of Economics. Thank you all for joining us today. And with that, Mr. Brinkman, you are recognized for 5 minutes.
Thank you, Chairman Paulson, Vice Chairman Lee, Ranking Member Heinrich, and members of the committee for affording me this opportunity to discuss Governor Bevin's Red Tape Reduction Initiative. Governor Bevin campaigned for governor in 2015 on the theme that is all about jobs, which at its core means creating a more inviting environment to attract both human and financial capital. To assist Kentucky in satisfying its financial obligations, Governor Bevin made the conscious decision to use every tool available to the administration to grow Kentucky's economic base and thus increase the flow of tax receipts into the state coffers. Although there are many aspects to job creation, a key component of that effort is regulatory relief, and one of the first undertakings of the administration was the formulation and implementation of its Red Tape Reduction Initiative. As part of this initiative, every cabinet and agency within the executive branch has been directed to review every regulation promulgated by it over the years and make one of the following determinations. First, completely repeal the regulation as its original purpose is no longer relevant. Second, amend the regulation to conform it to a federal counterpart. This effort includes eliminating inconsistent definitions and standards with the goal that the state regulation should never be more burdensome than the federal counterpart unless circumstances unique to Kentucky require a stricter standard. Third, amend and modernize the regulation to make it clearer and simpler to understand by those subject to the regulation, and also make it easier to update the regulation in the future. Fourth, combine the regulation with other regulations to include a single subject matter, such as fees or applications, in one regulation for ease of review by those subject to it. Finally, leave the regulation as it's currently written. The goal of the administration is to reduce by 1/3 the number of restrictions on businesses and individuals in Kentucky. In 1975, there were 4 volumes of regulations in effect in Kentucky. That number had grown to 14 volumes when Governor Bevin took office. Through the end of 2017, of the approximately 4,700 separate regulations on the books at the outset of the administration, 2,220 regulations have been reviewed, 372 regulations have been repealed, 327 regulations have been amended, 157 regulations have been targeted for repeal, and 433 regulations have been targeted for amendment. The initiative has the support of business groups, trade associations, chambers of commerce, and other organizations across Kentucky. There are several lessons to be learned from Kentucky's Red Tape Reduction Initiative. First, the governor must own the initiative in every aspect, and it helps to have a tangible symbol associated with the endeavor. In the case of Kentucky, we created the lapel pin that I'm wearing today, and Governor Bevin and his top officials wear this pin each and every day. Further, Governor Bevin speaks out regularly regarding the importance of the Red Tape Reduction Initiative to individuals and groups throughout Kentucky. As a result of the governor's leadership, there's growing awareness of the initiative every day throughout the Commonwealth. Second, it is important to create a website that is interactive with the public and allows for individuals to post recommendations on the repeal or amendment of regulations. Kentucky's Red Tape Reduction Initiative website is redtapereduction.com. Kentuckians have submitted scores of thoughtful ideas on how to reduce unnecessary regulations that drive up the cost of conducting business and create inefficiencies without contributing to public health or public safety. Finally, the effort of the cabinets and other agencies must be sustained on a regular basis. Our cabinets and other agencies regularly review and re-review existing regulations to ensure that the goals of the Red Tape Reduction Initiative are being met. This is a thoughtful and deliberative process that never ends. We are also in the process of digitizing and modernizing the manner in which we draft and promulgate regulations. The purpose of the Red Tape Reduction Initiative also includes helping to foster technological and engineering innovation. Governor Bevin's vision is for Kentucky to be the center for engineering and manufacturing excellence in America. This is already happening. Toyota Motor Manufacturing Kentucky, Inc., which has its largest assembly plant located in Georgetown, Kentucky, announced last year that it is investing approximately $1.33 billion to retool its facility in Georgetown to incorporate the Toyota New Global Architecture, which represents an entirely new manner in which Toyota designs, engineers, and manufactures its vehicles. Brady Industries will soon break ground on a $1.3 billion high-tech, fully integrated aluminum rolling mill at a location in northeast Kentucky, which will be the first new aluminum mill in the United States in over 30 years. It will incorporate technological advances in aluminum materials science that were developed by a team at the Massachusetts Institute of Technology. Finally, Amazon announced last year that it will invest $1.49 billion at the Cincinnati and Northern Kentucky Airport located in Boone County, Kentucky, to create its innovative, state-of-the-art global cargo hub. These are just a few examples of the innovation that is occurring regularly in the Commonwealth of Kentucky. Thank you, Mr. Chairman, members of the committee.
Thank you, and Dr. Kennedy, you're recognized for 5 minutes.
Thank you. Chairman Paulson, Ranking Member Heinrich, and members of the committee, thank you for inviting me to be here today. The task of regulating the economy is a necessary but very difficult problem. Congress and regulators need to view it from a dynamic viewpoint, develop rules that encourage firms to discover new ways to achieve social goals as efficiently as possible. Regulation is most justified when it addresses market imperfections. Rules that use market tools like price signals and information to fix problems are most likely to encourage innovation. So is regulation that gives companies clear long-term and achievable goals. ITIF believes that better regulation can not only remove artificial barriers to innovation, it can actually increase innovation by changing market rules to reward those companies that develop more effective, cheaper ways of attaining important goals. Intelligent rules can increase the amount of competition in a market. They can lower the barrier for new innovations. Smart rulemaking can increase the amount of information that customers have about different products, while unwise ones can reduce buyers' incentives to make wise choices. Rules that favor incumbents can raise entry barriers, while reforms that improve market structure can significantly increase productivity by speeding the use of existing innovations. Regulators can help this process by following a set of general principles. First, embrace innovation. Regulators should assume technology will continue to advance. Rules should not only anticipate innovation, they should encourage it. Second, embrace transparency. Congress, regulated entities, and the general public should have a clear view into the decision-making process of regulators, including any evidence or studies that they use to back their conclusions. Third, place more trust in the consumer. Given sufficient information, consumers can be their own most effective advocates. Firms that violate the public's trust often pay a heavy price in terms of profits and market share. Fourth, place more emphasis on reducing the cost of overregulation. Regulators should actively seek input from industry and major stakeholders on ways to reduce the cost of compliance without affecting public goals. Fifth, every major rule should undergo some level of public cost-benefit analysis in which the agency clearly explains why and how a rule will increase social welfare. To the extent possible, this analysis should be backed by quantitative studies. Sixth, regulators should focus on competitiveness effects. We increasingly live in a global economy in which domestic firms have to compete not just for foreign markets, but also for those that are here at home. Congress can further this effort by enacting legislation that does four things. The first is to encourage interagency and cooperation to undertake a comprehensive study of the global competitive environment faced by specific U.S. industries, including a review of the regulatory infrastructure, the regulatory environment that they face. Second, direct the Office of Management and Budget to evaluate the effect of major rules on innovation within the regulated industry. Third, update legislation in ways that give agencies more guidance and revoke obsolete rulemaking authority. Also hold more frequent oversight hearings to discuss regulatory approaches with the agencies. And finally, ensure that regulators have enough resources to attract the best people and to acquire a deep understanding of the industry they're regulating. I believe that these suggestions can be implemented rather easily, provided the necessary leadership exists. If enacted, they will have a noticeable effect on the quality of regulation. Thank you very much.
Thank you. Mr. Koopman, welcome, and you are recognized for 5 minutes.
Thank you, Chairman Paulson, Ranking Member Heinrich, and members of the committee for holding this important hearing today. I want to make 3 points in my testimony. First, the growth of the commercial internet was the direct result of a culture of permissionless innovation, which allowed it to create the massive gains in consumer welfare we've witnessed over the past 30 years. Second, the continued growth of this sector is being stifled by outdated regulatory approaches that are driving innovators to pursue better regulatory climates overseas. And third, we can reclaim this culture of permissionless innovation through a few simple reforms. As an open platform, the internet has allowed entrepreneurs to try new business models and offer new services without first seeking the approval of regulators. This is no accident. Bipartisan efforts in the 1990s made it the official policy of the United States. This guaranteed a platform with little prior restraint on the commercial activities undertaken on the internet. When harms and failures did occur, we addressed them in an ex post manner. However, as more industries have been disrupted by technology companies, this culture of permissionless innovation has been met with a permission-based, proscriptive regulatory approach. The costs of these regulatory approaches at both the state and local level are being felt more acutely today and by more people by the simple fact that it's easier than ever to jump into regulated industries. Within a few clicks, one can offer tax and legal advice to anyone, connect with a doctor thousands of miles away, chat with a therapist, or find a mover. Moreover, as entrepreneurs have brought these pre-internet practices into the internet age, they are encountering regulatory environments where smartphones, computers, and internets were never thought when they were created. One stark example of this comes to mind is the recent response by the Federal Aviation Administration to flight-sharing platforms. For decades, general aviation pilots and passengers were able to connect with one another via physical corkboards in airports all across the country. In 2013, a company called FlightNow created a platform that turned these physical corkboards into a digital app. This could have revolutionized the way we travel, and within a few years, the app itself had 25,000 users, pilots and passengers, connecting with one another to share flights all across the country. However, current FAA regulations and guidelines on flight sharing arrangements never contemplated the use of the internet. And as a result, the FAA relied on 30-year-old guidance documents to declare pilots using the platform to be common carriers. This meant pilots without commercial certification were operating illegally. They could continue to connect with passengers using the physical corkboards, but using the app to arrange the same flight was illegal. Discouraging this type of innovation in the United States doesn't necessarily mean this innovation will not occur. Rather than fighting with regulators, innovators will simply go where they are welcome. This is what my colleague Adam Thier refers to as innovation arbitrage. While flight-sharing platforms have been grounded in the United States, they've taken off in Europe. A European version of FlightNow hosts 150,000 users, 10,000 licensed pilots in France, Germany, the United Kingdom, and they're expanding across the entire continent. Now, why is that? Instead of viewing them as a threat, European regulators recognized these platforms were simply extending existing practices. They reformed existing regulations, and they actively worked with the platforms to promote safety. This is but one example. Innovators working on commercial drones, driverless cars, flying cars, and the sharing economy are all finding more hospitable homes outside the regulatory purview of the United States. Now, ultimately, to ensure that we remain a leader in the innovation economy, we must embrace the culture of permissionless innovation that fueled the internet's unprecedented growth over the past 30 years and all of the economic benefits that it has generated. To do so, we must balance important regulatory goals, safety, and consumer protection with a tolerance for mistakes, failures, and learning so that innovation can continue to move us forward. Doing so requires a technological freedom not found in many of our current regulatory approaches. It requires a humility to admit that we do not know what the future will look like, and it requires a willingness to admit when our approaches have outlived their usefulness. By shoring up boundaries of regulatory agencies and requiring agencies to take clear, concise, and consistent approaches toward regulating new technology, Congress can ensure a foundation for simple rules in our fast-changing, complex world. There will always be serious and legitimate concerns that make it tempting to require innovators to seek approval before they proceed. And while this may address many of these concerns, it is done at the expense of continued innovation and economic growth. And we should all be mindful of the effects that decisions made today will have on tomorrow's innovators and entrepreneurs. Again, I thank the committee for the interest in and attention to these issues, as well as the opportunity to testify, and I will welcome any questions you may have. Thank you.
Thank you. And Ms. Milano, you are recognized for 5 minutes.
I would like to thank Chairman Paulson, Ranking Member Heinrich, and Vice Chairman Lee, and all of the distinguished members of the committee for inviting me to testify today. I'm honored to be here to talk about my experience supporting safe and affordable access to credit for America's small businesses and entrepreneurs. Small businesses are one of our country's greatest sources of innovation. All of our most successful innovators, from Apple to Amazon, started small. Their meteoric growth was not inhibited by regulation, but could have been without access to capital needed to grow and scale their business. In my testimony today, I wish to discuss 3 important points. First, most small business owners believe some regulation is needed in a modern economy. While no one likes red tape and filling out paperwork, most Americans can appreciate that some regulation is needed to promote fairness and competition. In fact, according to a new poll released today by Small Business Majority, 3 out of 4 small business owners disagree that we should get rid of all regulations on business and think that some regulations are important to protect small businesses from unfair competition. What's more, an overwhelming majority of 82% agree their business can live with some regulation if it is fair, manageable, and reasonable. Second, many small business owners rank access to capital as a bigger concern than regulation. While our capital markets work well for most established, large, and mid-sized businesses, many small, early-stage, rural, minority-owned, and women-owned businesses often struggle to find financing and consistently rank access to capital as a bigger concern than regulation. Even more concerning, a growing number of financing products are being offered to these businesses by financial firms not subject to the same regulation and oversight as banks. According to another Small Business Majority poll, while small business owners felt that online lending opened up new sources of credit, 8 in 10 reported they were in favor of regulating online lenders to ensure that interest rates and fees were clearly disclosed to borrowers. And this brings me to my final point. Smart policy can promote safe and affordable credit and encourage innovation. Transparency is critical to promoting market competition, which should ultimately provide small business borrowers better products at better prices. But to ensure a level playing field among financing providers, disclosure requirements should apply equally to all small business financing products, regardless of whether the provider is a bank, credit card, merchant cash advance, online marketplace lender, payments processor, or any new companies yet to emerge. While transparency would make credit safer and more affordable, there will still be some businesses that will need help qualifying for a loan or accessing critical early-stage capital. I would like to highlight one of the very successful and innovative public-private programs I had the privilege of working on during my time at Treasury as a model for federal support for innovation and entrepreneurship. The State Small Business Credit Initiative was funded with a one-time authorization of $1.5 billion through the Small Business Jobs Act of 2010. It was a new program and a true experiment born of the need to jumpstart small business lending and investment during the financial crisis. The program worked by allowing states to set up their own small business support programs targeted to local economic needs. It was so flexible there were only 2 requirements. States had to establish at least one from a list of 5 possible credit or equity programs, and states had to provide a plan for leveraging $10 of new private sector small business financing for every $1 of SSBCI funds. Unlike other federal programs, it was not a one-size-fits-all approach. Some communities chose to target micro-businesses, while others targeted manufacturers or high-tech companies. In total, SSBCI funded 154 state programs, over 80 of them new, and dedicated $1 billion to lending programs and $400 million to venture capital programs supporting early-stage businesses. From 2011 to 2016, the last year data was available, SSBCI supported over $10.7 billion in new lending or investments and was estimated to have created or retained over 240,000 jobs. In total, it supported $2.5 billion in financing for small manufacturers, $1.5 billion for women and minority-owned firms, $4 billion to early-stage businesses with high growth potential. And even more remarkable, with no federal requirement to do so, over 42% of SSBCI loans or investments were made to businesses in low to moderate income communities. SSBCI illustrates the power of leverage, a little bit of federal support partnered with state and private sector resources, and the power of flexibility to drive innovation and inclusive economic growth. We need more smart policy like SSBCI, and I recommend to the committee, if you are considering policies to support innovation in small businesses, you should consider reauthorizing SSBCI in some form. Thank you.
Get that. Thanks, Ms. Milano. And we'll start our questions now. Maybe just to begin, as we referenced the article earlier, the Bloomberg article, where the United States has now fallen out of the top 10 in innovation. And obviously there's concern there, but I think what was even more concerning in the article was the prediction that some have also made about that trend is going to get worse rather than get better. So my question is, and I'll just start with you, Mr. Koopman, how do regulators allow for a culture where it is okay for innovators to be doing their thing? And you referenced the internet, for instance, the FAA, and some of the flight sharing components for an app. And when is regulation necessary? How do we ensure that it's tailored and it's not going to be immediately outdated? And what are some examples of what our other major trading partners or other allies and economies around the world doing to orient themselves on regulatory change and regime as a competitiveness argument?
Thank you very much for the question. I think the most important thing regulatory agencies can do to embrace a culture of permissionless innovation, first and foremost, is to sort of separate the idea of harm from fear. I think especially in the emerging tech space, very often every new innovation is followed by, techno panics, if you call them that, where people think the latest technology will ruin the world or make people less safe or harm us in some way. And those fears may be legitimate, and it requires the agency to do one of two things: to step in and say, we don't have enough information at this point to make that decision, or to say, yes, there is clearly tangible, irreversible, catastrophic harm, and it's time to narrowly tailor a regulation to ensure that harm doesn't come to pass. I think it's the most important thing an agency can do is to base regulatory decisions around actual harm as opposed to the fear of harm. And I think the perfect example of this is flight sharing, as I mentioned before. The FAA is a safety agency at the end of the day, and their concerns about flight sharing, general aviation pilots using an app to connect with passengers, was one of safety. At the same time, you have this European example where the European Aviation Safety Administration has embraced this and said there's no clear harm, and we will play an active role in setting up norms and practices and procedures within the industry to ensure that the feared harm never comes to pass. I think that's one perfect example of this in a way that you see this also in drones, another emerging technology where you have companies, Google X, for example, built most of their technology in the United States, and a lot of their testing initially was done in Australia because the Australian regulators had embraced the idea that you can fly a drone over someone else's head without hurting them, while it was still, very much a heavily regulated industry in the United States. I think those are two examples of where trading partners are taking a posture toward permissionless innovation, and you're seeing U.S. born ideas and U.S. innovations going overseas.
Dr. Kennedy, maybe you can add too, drones, driverless cars. I mean, maybe you can expand on that. Any other?
Sure. Well, yeah, I recently came out with a report last year, I think, on the automation that's occurring in the freight transportation industry. Whether it's trains or freight trucks or drones or even airlines, every industry is automating. The technology is advancing quite rapidly. And I think the best thing that the regulators can do is one, take some responsibility for how the competitiveness of the industry internationally, and say, in addition to guaranteeing public safety, we also have to make sure that this industry can continue to compete strongly in global markets. And then work with the agency to try and identify the true public safety issues that are involved in moving to greater automation, and to find ways to get around those. I think usually once we identify the legitimate concerns or dangers of a technology, we can find ways to get around it. I think in the past, if you look at the history of technology, there's always been a tendency to fear the technology and to want to put a brake on it until you understand everything that could possibly go wrong. And nobody wants, if something goes wrong, nobody wants to take the responsibility to say, yeah, I authorized that because I thought it was worth the risk. I thought the benefit of the technology in the long term was worth, a couple accidents. And all technologies have to work through problems, but eventually we get there. Eventually we come out with solutions that make substantial contributions to the way we live.
Thank you.
The regulator has to accept that as a challenge.
Senator Heinrich, you're recognized for 5 minutes.
Ms. Milano, banks are more reluctant these days to make loans to small businesses, both citing high costs and low profits. And as a result, borrowers are oftentimes looking to new sources of capital, including fintech, that operate in some cases without real oversight. What are some of your concerns about turning to fintech lenders in this environment, particularly online lenders? Your mic's not on.
Sorry, thank you for the question, Senator Heinrich. So I think we have seen sort of a shift. I think that small business lending, particularly small dollar loans under $100,000, which are what the vast majority of small businesses seek, have gotten, they have high fixed transaction costs and underwriting costs relative to revenue generation potential for community banks. And we've seen a decline in community banks, less than 10 billion assets share of that lending, and more of a movement towards credit card products and emerging online fintech providers that are sort of credit scoring businesses online and underwriting loans that way. And I think one of the concern online is that it's buyer beware for small businesses. I'm on the board of directors of Small Business Majority. They do polling of small businesses. They're a national advocacy organization that have 55,000 small business members nationwide. And what we've seen is that there's not a lot of transparency about the prices, the interest rates, the fees associated with these products. And there's a real desire for an extension of common disclosures that would basically level the playing field and provide transparency to the market.
That gets to the heart of an issue with regard to access capital. How do we do a better job? We have these different platforms. We have credit cards, we have fintech, we have community banks, we have big banks, we have credit unions. How do we do a better job of treating everyone equally and transparently in that regulatory environment?
Right. I don't think you regulate the entity. I think you regulate the activity. And you basically say, whether it's a loan or a credit product, there are certain key pieces of information that consumers or borrowers need to have. And that's sort of the interest rate, any fees, and there's more about this in my paper, and the payment terms and things like that. And this is information that, if it's available, borrowers will actually be able to shop and compare across credit providers and know what's a better deal and what's not for them. And nobody really in the market should be threatened by that, because that's just promoting better products at better prices and fairer competition.
I think one of the challenges is we all live in a world where there's a historical inertia, and so we've sometimes set things up to, by default, regulate the entities based in what box you check as opposed to regulating the activity. Dr. Kennedy, there's been a big focus today on the importance of deregulation and less focus on how, as you do that, you make sure that you're doing it in a responsible way. And I thought you were very sort of measured and balanced in your testimony today. No one likes red tape, that's obvious, but it's been my experience that my constituents like to breathe clean air, and they prefer that when they drink water, it's clean water. When my mother worked in a factory, she was more than happy to sign up for long hours and hard work, but she didn't sign up for carpal tunnel syndrome. In designing regulations, how do we make sure that we consider both the costs and the benefits, and how do we ensure, once again, those issues of transparency and level playing field across platforms?
Yeah, I think two or three things that I think, especially at a big level, are important. One is I think the regulator has to it has to measure potential benefits and harms of a technology in a clear way. In some of the environmental issues are sometimes the hardest because they're difficult to quantify, the benefits of clean air or clean water or better worker safety. But I think it's Congress's job to set a level for what's safe. And then it's the regulator's job to try and achieve that level, but try and achieve it in the most efficient ways. And a lot of times, regulators have used command and control methods or dictated the use of a certain technology, and that can sometimes work when the technology is there and you just want to, it'll let you achieve the level you want and you never want to do better. But we should accept as a goal or adopt as a goal that we want to do better and better and better over time. We want cleaner and cleaner air. We want better and better worker safety. And for there, I think you measure the results. You measure air quality. You measure the number of sick days. And you try and find a way to reward companies that do better over time. And you invite in and even help develop technology that would get you improved performance.
Thank you.
Thank you. Senator Lee, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thanks to all of you for being here. I appreciate the insight and expertise each of you brings to this committee. Mr. Koopman, you've previously written about how local land use restrictions end up having an impact on hardworking Americans by restricting the supply of housing and, in the end, raising prices. The local zoning laws, in many instances, have an impact on development, and they end up discouraging economic innovation. This problem is compounded in a state like mine, where there's a whole lot of land that's owned by the federal government. At present, the federal government owns about 2/3 of the land in the state of Utah. And so, without considering the impact of state and local laws restricting land use, which we have those too. But on top of that, in Utah, we also have this restriction that just says that there's only about 1/3 of the land that can ever be developed for anything, for housing, for recreational purposes, for grazing and so forth. And so, unlike people in many states, people in Utah are limited by both state and local land use restrictions and also the federal overlay that comes with federal public land. Can you just tell me about how this strikes you, about the relationship you see between land use restrictions at the state and local level on the one hand and the federal government on the other hand, and how they have an impact on the availability of housing and the pricing of housing?
Yeah, thank you very much for the question, and I think this goes to a point that Ranking Member Heinrich mentioned before, that 20 counties, I think he said, had an overwhelming majority of these startup and innovation activities. And I think that goes to the heart of the point. You think of San Francisco, the Bay Area, for example. There is all of this economic activity occurring and yet it's far too expensive for people who could pursue the jobs being created by many of those companies to move there because land use regulations quite simply make it too expensive to move there. And geographic mobility is very much a chief component to income mobility. Being able to move to where work is an important part of getting the work, is being there and showing up and having the job. So the restrictions, the inability to develop land locally, be it from a federal restriction, a state restriction, or a local restriction, is a chief barrier in many instances to people finding meaningful work and opportunity, because you do, again, end up with this mismatch where you have a supply restriction, a regulation, either a federal, a state, or a local level that says you cannot build a house here, but you have a high demand for jobs holding the supply constant. The demand increases, you will see the prices go up and up and up. This is something we've experienced here in D.C. as more and more people come to D.C. You see this in the Bay Area. You see this in Salt Lake City and elsewhere as jobs continue to be needed in a particular area. A big part of that is having housing available.
Are there policies we could pursue through legislation or otherwise that would help alleviate this burden?
Oh, certainly. At a state and local level, there are many things that policymakers could do to take positive steps toward unleashing the supply of housing.
What about Congress? Do you think there are things Congress could do to impact at least the federal role, the role the federal government might have in public land states, for example?
Oh, certainly. And I have to say, I just moved to Utah a week and a half ago. And I'm very much
so pleased to have you there. And
you've
you've moved to Utah at a very good time of year.
Yeah, it's been beautiful. Don't tell my wife about the snow. We've just moved to Utah, and I can't speak specifically to the issues of public lands, but definitely seeing there are vast amounts of the West owned by the federal government that could be put to beneficial use in various ways. This isn't returning it to the states or privatizing it, but the federal government taking a more active role in allowing for multiple uses on public lands could certainly go a long way toward some of these housing affordability issues in the long term.
And to be clear, you're not talking here about national parks, about wilderness areas. Most of the land that is public in Utah doesn't fit into any of those categories. It's just garden variety land, right?
Correct. I'm not saying shut down parks. I'm not saying anything like that. What I'm saying is in land that is held by the federal government and isn't being put to use currently, that's an opportunity for Congress to look and say, can it be put to better or different use?
Thank you very much, Mr. Koopman.
Thank you. Ms. Maloney, you're recognized for 5 minutes. Representative Maloney.
Thank you, Mr. Chairman and Mr. Ranking Member, for holding this hearing. I view innovation as one of the key elements of the success of our country. This is an important hearing. But of course, regulations, we don't want so few of them that we have things like the 2008 economic downturn that before this committee, one economist after another said it could have been prevented with good regulations and good oversight, could have prevented the catastrophe that resulted in over $15 trillion lost in household wealth, 9 million jobs, 8 million homes, just a devastating downturn that could have been prevented. Part of the reforms was a credit card bill of rights. It was a bill that I authored, and 9 years ago today, President Obama signed it into law. And some of the protections of this law, to name a few, was that you could prevented companies from applying payments to balances with the lowest rate before balances with the highest rate, banned fees from being upped without the customer's knowledge or consent, said they had to really do what they said. If they said that an interest rate was a certain interest rate for a year or 2 years or 3 or whatever, they had to keep their word. So it made many things. They banned the practice of raising rates after purchases have already been made. I heard stories where they were told the rate was one thing. The next day they bought a car. Then the next day they raised the rate to 21% and kept them in poverty and never-ending debt. So I'd like to ask all of you, would you call these regulations, some of which I just mentioned for the credit card industry, unnecessary, red tape? Ms. Milano? Yes or no?
No.
Would you? Just go down the line. These credit card abuses that I outlined, would you consider it red tape or relevant and necessary? By the way, 3 different reports said this bill saved consumers over $12 billion a year, keeping their money in their own pockets, not going for unfair, unnecessary fees. Well, I'll just take one answer since, do you think it's do you have a response?
Yeah, I'm not a financial markets expert.
Okay,
but
well
no,
then let
it
me just
doesn't.
go on. Well, personally, I'm just making a point that there are some regulations that literally save pain and suffering and literally save consumers and help the vitality and investment in our economy. Mr. Koopman, last month, the Office of Management and Budget released a report which estimates the cost versus the benefits of federal legislation and agency compliance. You are an expert on regulation. I assume that you are familiar with the report. Yes or no? Are you familiar with the report?
I have not read that report, no.
You haven't read it? Has anyone read it?
Yes, I read it.
You read it, okay. Can you tell me the most basic way, the findings of that report?
Yes, it's a report OMB produces annually and has done so for the last 10 years. And at a very basic level, the most recent report, which was released under the Trump administration, showed that the estimated benefits of government regulations amounted to $287 to $911 billion versus cost estimates of $78 to $115 billion. So at a minimum, benefits outweighed costs 2 to 1.
Well, I'd like to follow up with another question for you. In your testimony, you argue that overregulation likely is not the primary restraint on small business formation and innovation. You argue that access to capital is a primary barrier. And I'd like to go a step further and ask you if you could provide some insight on small business formation at the ground level. Let's say that I want to open up a small hardware store or restaurant. Could you just make a comment on that?
Sure. I mean, I think that, the vast majority of businesses in this country, 76% have receipts less than $100,000. They're very small businesses. And the first place you start if you want to open up a hardware store or move from a food truck into a restaurant is with the need for credit. And a lot of times it's with personal credit or, home equity. And then the next step up is to try to go to a bank and get a small business loan or to turn to an online lender or to use a business credit card, since you mentioned the CARD Act, which excluded business credit cards. And oftentimes there isn't an easy way to compare and price shop those products because there are no disclosure requirements around the fees and the interest rates that are being charged for those products.
Mm-hmm. Oh, my time has expired. I yield back.
Thank you, Representative Schweikert. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Can I ask for a bit of a thought experiment for all of us, our friends on the left and those of us here on the right in our panel? Okay, regulation. What's its basic purpose in our society? Is it to keep us safe, keep us healthy? Okay. Are we comfortable with that as part of the thought experiment? So in many ways, if you actually look at much of our regulatory model, it's as if we're still in 1938. Let's fill up file cabinets full of paperwork that will document that we intend to do certain things, and if we do something wrong, we have documentation to say you screwed up and to penalize you. A good example, as was just brought up by the woman from New York, is 2008. If you actually read the literature, and I have stacks of it on my nightstand, it turns out we had a crisis of information. No one knew what was in these securitizations because we didn't have information. You could not see what was the impairments within the securitization of the MBS. Turns out information was the solution in that regulatory environment. I'm sometimes enraged the fact that this isn't the ultimate regulator. In air quality, we now have technology. I can attach something to my phone that will do hydrocarbons, PM10s. If I could have a few thousand of those moving through my community, I would catch bad actors instantly. instead of having someone fill up a file cabinet and a couple years later I'll find out they screwed up because they didn't meet their certification, and we'll have documentation pursuing them. But instead of moving to a crowdsourced, as you talk about access to capital, we passed the Jobs Act a few years ago. It took how many years to basically have the SEC screw up crowdfunding? How about crowd lending? How about Reg A Plus, the roadshow, all the things we were doing to try to create egalitarian access to capital? And in many ways, it was the very regulators who screwed up the access to those things instead of moving to an information base that if you wanted to crowd lend something, give me enough information, and the information becomes the regulator. In many ways, I'm sorry, I know I'm going on a bit, but I'm frustrated because it's as if we're still here trying to find a better way to allow Blockbuster Video to have a drive-through instead of the revolution of the fact I go home, I hit a button, and now my movies and entertainment are streamed to me. We're defending a model that's decades out of date technology-wise. And Mr. Koopman, you're the only one who's actually said anything that provides me hope. How do I help my brothers and sisters and all of the rest of us in this thought experiment understand the power of information is the ultimate regulatory box because it identifies the sinners?
I think the best way to do it is to add a concrete example to your thought experiment. I use this with my students in our economics of regulation class that I've taught for the past couple of years at George Mason. And that is when you're taking your family out to dinner and you want to know a good restaurant, where do you turn? There are, in most cities, there are city health inspectors that are making sure that the restaurants are clean, they're not serving bad food, they're not making people sick. But at the end of the day, most of the information we get and most of the information we use about who we deal with are coming from places like Yelp. I mean, this is the way that technology acts as a regulator, by breaking down information asymmetries and giving more information to consumers, that they can police bad actors within an industry by saying, we will not work with you anymore. You could think of the Delete Uber campaign. Hashtag Delete Uber campaign is a perfect example of this, of making it clear to a company that consumers, as regulators, will not deal with things that they don't like.
Okay, Mr. Kennedy, you have something, and I'll beg of you to go really fast.
Yeah, well, nobody's questioning that regulations on whole benefit the economy, but there are many regulations that don't benefit the economy, and I think most of the regulations that Congress struck down on using the CRA were good examples of that.
Well, and I'm so sorry, I'm going to interrupt you.
Okay.
I will make you an argument that if I want to have telemedicine, I need to break down layers and layers and layers of regulation, whether it be my state licensing boards, the way we compensate, the way we say the algorithm that may be talking to my wearable has to be a medical device under certain regulation. I can make you an argument that the most elegant thing we could do with the Securities and Exchange Commission is have trades and those things run on rails where the algorithm and the regulator can see it live and see if someone's cheating, breaking the rules, and you catch it instantly instead of a quarter later someone files a piece of paper and we find something on the piece of paper and we go back in time. How do you embrace technology so regulation of protecting the public, our health and safety, is live instead of a paperwork process of filling up file cabinets? So with that, I yield back.
Thank you. Senator Hassan, you're recognized for 5 minutes.
Well, thank you very much, Mr. Chair, and thank you to our panelists for being here, for your expertise and your hard work. And I was just listening to Representative Schweikert and thinking that I'm not sure we're debating really regulation good or regulation bad as absolutes. What we're really trying to do is how do you do it well? In my state, to have access to telemedicine, before you have the iPhone, you need broadband, and you need connectivity, and you need help investing in that, and that is something that it has been very hard to get the government to do, to turn around and say we're in a new digital age, and we have to actually invest in the kind of technology that would give our regulators the access to the tools they need to modernize. And so, I think that's an important touchstone. You can't just in government wave a magic wand and suddenly have the tools that you need to catch up to the digital age. And I think we are way behind in investing in that. I'm also right with Senator Heinrich in saying nobody loves red tape, but all of us, I think, and you've all agreed in some way, appreciate that regulation helps the quality of life we all enjoy. In my family's case, my son has an implanted pump that helps his spasticity from cerebral palsy be relaxed. I want to know that the baclofen pump that was implanted in my son is a safe medical device, and we need regulation to establish the parameters. We also know, to Ms. Milano's point, that in order to ensure fairness and competition, we have to sometimes evolve as an industry evolves. And that's why I think it was important and right that the Senate just voted to reinstate net neutrality, because without that level playing field, small and emerging internet companies can't compete with the big guys, and people can't have access to the internet and a fair and even playing field that would help them start that new business. So I think it's a subtle conversation we need to be having, and I'm very appreciative of the work you are all doing to help us do that. Ms. Milano, I did want to turn to the issue that you've raised about what you're hearing from small businesses, because it's what I hear too, that it's really hard for them to establish or expand because of limitations on access to capital. So in particular, what are some of the ways that we can encourage capital to be invested in diverse geographic areas and rural communities, and not just places like Silicon Valley and New York?
It's a great question, Ms. Hassan, and thank you for asking it. I mean, I think first off, you've introduced a bill, the ROI Act, to relieve student debt so that more young entrepreneurs and innovators can get started on starting their businesses and helping to grow small businesses in their communities, and I think that's really important. I think secondly, you know, for so many small businesses, particularly in rural areas, they will need the support of programs like CDFIs. You know, I oversaw the CDFI program. CDFIs are very special institutions which serve low-income communities and help with business counseling and technical support and all the wraparound activities that help rural businesses get ready to really grow with the capital they're provided. And we need more support for CDFIs and for small business administration programs.
Well, thank you, and thank you for mentioning my bill, because I was going to ask you about that too. We are seeing a big drop-off in young people starting businesses, in part because of the kind of student debt they have. And so the idea behind the bill is simply to allow people who start businesses, especially in distressed areas, to have a break on their student debt. I thank you very much for your testimony. Thank you all for being here. I'll yield the rest of my time.
Thank you. Representative Handel, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all of you for being here today. I appreciate your comments. Chairman Paulson had referenced earlier the Bloomberg Index, Innovation Index, saying that the U.S. had sort of ceded its top 10 role, yet in the 70s and 80s, we were arguably the most prolific global innovators. And I would just be curious what you think is different from then versus now in terms of that regulatory climate. Start with Mr. Koopman and then Dr. Kennedy.
So I think that when you look at, let's say, the last 30 years and the growth of commercial activity on the internet of the last 30 years, this goes to Congress in a nonpartisan agreement that the internet would be a place of permissionless innovation. I think that's where you see the growth in the last 30 years. Why you see a slowdown total factor productivity in the United States has been declining for 10 years in other sectors. And you see this difference, and I think what we're recognizing now in the decline in innovation in the United States is one where, as tech has grown off the internet and into the world where all of us are interacting with it every day, technology is now interacting with 30, 40, 50, sometimes 80-year-old regulations that have more or less, put its gangbusters growth to a halt.
Dr. Kennedy?
Yeah, I think that one of the things that's happened over the last couple decades is we had a couple of financial crises caused in part by some bad actors. And in each time, we passed massive financial rules to make sure nobody ever made that mistake again. And what it did is it created a whole layer of cost on top of the system that slowed down IPOs, that caused companies to withhold credit or not be so interested in giving credit to small businesses because of the high fixed costs. I think we've also lost some of our confidence about the future. I mean, we should. I think the U.S. is going to be the most productive country in the world over the next 20 years. I really believe that. We have a lot of problems, but we have far more strengths than problems, and we are better placed than Europe or China or Russia. And yet, you look around the country and you don't see that optimism. You don't see that dynamism.
I don't know. I'm
except
feeling
in
pretty
certain
optimistic
places.
with 4.1% growth compared to what we had before, thanks to the Tax Cuts and Jobs Act.
Well, I hope it continues, but.
And then I just have a little bit of time, so let me just jump in here. I think there's no question that we have an extraordinarily static regulatory climate. And to your point, Mr. Koopman, just the layering of decades and decades of regulatory rules. But it is a Herculean effort to start to unwind that. What can we do to really practically go in? Certainly, to your point, Dr. Kennedy, cost-benefit analysis going forward. Do we need to go in and have a sunset rule on major regulations that inject some process so that we don't let it build up for 80 years? Dr. Kennedy and then Mr. Koopman.
Two things. One is I think Congress needs to revisit rules on a regular order and see if the rules it's written that govern the agency make sense. Mm-hmm. And when you revoke a rule, my understanding is you revoke the regulations that were authorized by the rule. Another thing is I think we ought to look at some industries like construction and healthcare and education and say, why haven't we gotten productivity there? Mm-hmm. And why don't we focus on driving down the cost, improving the quality of higher education or healthcare, and how can we restructure the rules of the market to make, by giving consumers more choice, by making them more responsible for their actions, by reducing regulations, say, on a medical app. I think there are lots of ways that when you get in the weeds, you can find specific rules that'll make, that you can get bipartisan support on, and that will make a noticeable difference.
So in other words, for Congress to be more proactive in being dynamic about looking at the climate versus
I think that would help
static on our side. My time is out. Thank you so much. I yield back, Mr. Chairman.
Thank you. And Dr. Adams, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you all for your testimony today. My question is for Ms. Milano. First of all, let me just say I believe that we must ensure greater access and more options for entrepreneurs to obtain responsible capital by providing small businesses, particularly minority businesses, with increased opportunities to participate in small business administration programs. HBCUs, it's historically black colleges and universities, provide education and training to a large share of our nation's African-American population. In particular, HBCUs prepare many individuals to embark on small business ventures, yet too often, HBCU students and alumni are left out of the small business training equation. My question, do you think it would be helpful for the SBA to conduct a specific outreach campaign to HBCUs, and with targeted SBA outreach increase the likelihood that minority-owned small businesses succeed?
Great question, and thank you. It's a really, really important issue. There's a paper that I cite in my report that Center for American Progress did that shows that small business ownership and entrepreneurship is really, really important wealth-building tool for minority communities, African Americans in particular. If African American families that own their own small business have $52,000 in total household wealth compared to $7,000 for non-business owning families. And so it's a really, really important tool to help minority communities move up the economic ladder and have access to the middle class. And I think that one of the ways that you get there is with the support of programs like SBA and more entrepreneurship mentoring programs and outreach programs that help show folks what's possible and how to get from step A to step B. So yes, I think it would be very helpful if SBA, through their entrepreneurship programs, through SCORE and the Small Business Development Centers, coordinated and did more direct outreach to historically black colleges and universities. They are operating on a shoestring budget these days, so I don't know how likely that is to happen anytime soon, but it would be wonderful if it could.
Okay, so the specific steps that you might recommend, you mentioned SCORE or the others, that SBA might take in order to fully engage these communities?
Well, I think that there are a couple of steps they could take. One would be to do more direct outreach, as you mentioned, actually go out to schools and try to do more events on campus and attract more people to come and learn about the resources of the SBA. And then, in addition, business owners need capital to get their business started. So the SBA microloan program is very important to these communities, and funding that program, continuing that program would be very helpful in terms of helping these communities access capital.
Thank you. Since the hearing today is about the innovation economy, what would you think would have a greater impact on innovation growth? Spending $1.6 trillion on tax cuts or $1.6 trillion in research and development?
Well, I would say $1.6 trillion on research and development, but the vast majority of businesses, I've said this 3 or 4 times now, 76% have annual receipts of $100,000 or less. They're not benefiting from the tax cuts. So anything that would help them access capital or would increase our overall country's contribution to R&D would be a better use of resources.
Thank you very much. Mr. Chair, I yield back.
Thank you. Mr. Byer, you're recognized. Representative Byer for 5 minutes.
Mr. Chairman, thank you very much. Dr. Kennedy, I served in the Virginia Senate for 8 years and noticed that virtually every business legislation we passed there was to restrict entry to the businesses we were already in. It was in restraint of trade. And yet we find that there's so much consolidation in so many different industries right now that many are encouraging regulatory policies that are designed to foster competition, to restrict consolidation, to restrain the crowding out of possible new entrants. How do you see the role of regulatory policy in actually maintaining market competition?
Yeah. Well, I think that too often we get into the habit of thinking that big is bad and small is good. And I think the president of ITIF just came out with a recent book that basically challenges that premise and points out that in many industries, there are scales of economy, there are network effects where prices go down, the bigger the industries get and the more sales they make. He also points out that large companies spend more on R&D. They pay their workers more. And so I don't think we should look at the size of a company when we develop a policy. Instead, we should be sort of size neutral. And we should say, what rules do we really want to govern in this industry? And I think when we do that and we look at some of the promises of technology, we can find a lot of ways that we can promote high productivity. Like one is encouraging telemedicine. I mean, that right there would make a big difference in driving down prices and increasing quality and access.
Let me move on, because I know you've written on this in the past, but wouldn't you think that implementing a carbon tax to fund the latest tax reform would have made a lot more sense than creating the largest legislative deficit in history?
I wrote a paper advocating that the carbon tax be used to pay for part of the tax bill.
Sort of the classic case of letting the market achieve the goal of lower carbon emissions rather than doing it through regulation.
I think the carbon tax is a much better way, and I think most economists would agree, of approaching the goal of getting carbon emissions down. We did write, I wrote also that corporate tax reform was very important to our economy, especially in globally competitive industries where our companies are competing against companies that have tax rates 10 percentage points or more lower.
Yeah, let me move on. Thank you, Doctor. Ms. Milano, in all your the small business background, but you didn't mention anything about deregulation of the banking sector in your testimony, and yet you talked about the scarcity of capital for small businesses. Do you see the regulatory environment at all as a primary impediment to small businesses in seeking to raise capital? Is there a connection between the two?
I personally don't think so. I mean, I think that what's happening, particularly in the small dollar loan market for small business loans under $100,000, it's a profitability issue. These are, for community banks, these are high-cost loans to acquire, service, underwrite, and relative to revenue generation potential. And so you're just seeing banks do less of them. And the decline predates Dodd-Frank and predates the recession. Chicago Fed did a paper using flow of funds data that showed from 1997 to 2015, there was a drop from 82% to 29% of small business loans under 100,000 being done by community banks. So I don't see it as a regulatory issue. I also, if you look at the numbers that the FDIC just put out today, record 56 billion net income, in the banks. And so I don't see how regulation is hurting bank lending.
Thank you. Mr. Koopman, you talked about Yelp and you're taking your kids to dinner. That we use Yelp all the time and things like it, but we also assume that the health department's made sure that the food's okay. We're not going to get poisoned afterwards. So, that you need both the regulations that the restaurants are healthy, clean, and safe, and then what's the good restaurant using Yelp?
Oh, certainly. And actually, I think there was a recent story maybe a year ago that health inspectors in New York were actually choosing New York City that is, we're choosing which restaurants to inspect based on Yelp reviews. So I think there is a role for regulators to be better informed with this information, as well as members of the industry, be it consumers or producers, to make sure everyone's playing their proper role and allowing for the next Yelp or whatever that is to continue to provide more tools to both consumers, producers, and regulators to make better, more efficient decisions in the marketplace.
Thank you very much. Mr. Chairman, I yield back.
Thank you, Representative Beyer. And just to wrap up, I want to thank everyone for taking the time to testify and be here today. We appreciate your time before the committee, and just remind everyone also, if members wish to submit questions for the record, I know we'll have some. The hearing record will remain open for 5 business days, and with that, the committee is adjourned.